Hey everyone, welcome back to Corporate Decoder. Today, HeartBeam Incorporated BEATW just filed a current report, and I am seeing a move that could unlock significant capital. Quick note, this is not financial advice, just my take on public filings for educational purposes. The company is planning to sell a lot of stock, and that could change things quite a bit. So what we have here is a Form 8, which is basically a company telling the public about major events that have happened. Think of it as a notification system for investors. HeartBeam Incorporated filed this on the 14th of August 2026, and the big news is about a new agreement to sell their stock. The main point is an at-the-market equity offering sales agreement. In simpler terms, HeartBeam has struck a deal with a company called Titan Partners Securities LLC, which will act as a sales agent. Through this agreement, HeartBeam can sell its common stock up to a whopping $25 million worth whenever it decides to. This is often called a shelf offering because the company has already registered the stock with the Securities and Exchange Commission, making it ready to be sold quickly. This means HeartBeam can raise money as needed, essentially tapping into the stock market for funds. The shares are intended to be sold on the Nasdaq Capital Market, and the sales agent will get a commission of up to 3% of the gross sales price. This is a common way for companies, especially smaller ones, or those looking to fund growth or specific projects, to get cash without taking on debt. Now, HeartBeam's stock trades on the Nasdaq under the ticker symbol BEAT, and its warrants trade as BEATW. This filing confirms they are actively working with their common stock and warrants. This at-the-market offering is a flexible way to raise capital. It is not a fixed amount at a set price like a traditional stock offering. Instead, they can sell shares opportunistically when market conditions are favorable. The filing also lists out the exhibits that support this announcement. These are the actual legal documents, like the sales agreement itself and legal opinions. Think of these as the supporting evidence for the news they are announcing. For us, the key takeaway is the intention to sell up to $25 million in stock. Now, when a company like HeartBeam decides to sell more stock, it is really important to understand the potential impact. They currently have a market capitalization that is quite small, and this $25 million offering represents a significant chunk of potential new money. For example, if you look at their current stock price, which has been trading in the pennies, this offering could effectively double or even triple the amount of capital the company has available if they manage to sell all of it. This type of capital raise is crucial for companies that need funds for product development, clinical trials, or to expand their operations. From what I am seeing in the research context, HeartBeam has had some positive news lately, like their Q2 earnings call presentation and mentions as a potential growth stock. They also had some insider activity with a bonus grant to their CTO. However, the stock price has been very low, trading around $0.02 to $0.02 recently. This makes the $25 million offering a very substantial event for them. It is a clear signal that they are looking to significantly bolster their cash reserves. The risk here is dilution. When a company issues more shares, the ownership percentage of existing shareholders decreases. If they sell the full $25 million, it could lead to a considerable dilution for current investors. Historically, companies that rely heavily on these types of at-the-market offerings often do so because they have immediate cash needs. We've seen companies that do multiple dilutive offerings struggle to gain significant long-term traction. For instance, back in 2021, Kodak did a large stock offering to fund its digital initiatives. And while it provided capital, it also significantly diluted existing shareholders. A $1,000 investment in Kodak at that time could have seen its ownership percentage decrease substantially. What I'm actually looking for is how they plan to deploy this capital to generate revenue and profit growth that justifies the increased share count. The big question will be whether this influx of cash can translate into a sustained increase in their stock price and valuation. Oh, and the research tools I actually use are linked in the description. They help keep this channel going. That is my take. Stay decoded. If this analysis was valuable, hitting that like button really helps, and subscribe for more deep dives. Check out the Discord in the description.